What's the best way to track your investment portfolio? Some people rely on their broker for records, others throw together a simple Excel spreadsheet, and some even build really complex ones. Then there are purpose-built tools like Sharesight and Navexa. I have been through all of those stages myself, and honestly, after using Sharesight and Navexa, I couldn't go back to any other way. In this video, I'll walk you through 7 big reasons why you are missing out if you're not using a tool like this. Reason number 1, easily manage multiple brokers and entities. Over time, you might try out different brokerage platforms. For me, I started with ComSec over 10 years ago, then moved to CMC Market and added Self-Wealth along the way. And now my main brokerage account are Moomoo and Stake. Honestly, if I won't use Navexa or Sharesight, I'd be really reluctant to switch brokers or maintaining that many accounts. It would be an administrative nightmare to keep everything tracked. But with these tools, it's effortless. The setup is simple and they consolidate all your data across brokers so you can see your entire portfolio in one place. Got different types of investment? That's easy. You can add shares, ETFs, managed funds, crypto, and even investment properties. Got different entities? No problems there either. You can set up separate portfolios for yourself, your spouse, a self-managed super fund, a family trust, a bucket company, and even one for each of the kids. Everything shows up under one account with a single subscription fee. You get full visibility over all portfolios, and if you want, you can share access to individual ones with others like a family member or your accountant. One of my favorite examples is creating a portfolio for a child who is new to investing and giving them access to just that one. You can keep an eye on their investments while they get hands-on experience learning how to use a portfolio tracker themselves. Reason number 2, see the true performance of your portfolio. Here's something most brokers won't show you, your true return. Typically, they just compare what you paid to the current market value and show a profit or loss. If you're only holding ASX-listed investments and reinvesting all dividends, that might be close enough. But if you're receiving cash dividends or holding investments in foreign currencies, that's far from the full picture. Ignoring dividend returns or currency impacts can produce misleading numbers and lead to poor investment decisions. Navexa and Sharesight break your total return into 3 parts. Capital gain, the profit or loss from share price movements. Income return, the gross income received, including franking credits. Currency gain, the impact of exchange rate movements. This breakdown gives you a much clearer view of your portfolio's true performance and characteristics, whether it's income-focused or growth-oriented, and how much currency movements influence your returns. You can customize the time frame and even drill down to see these details for each individual investment. Reason number 3, keep your cost base accurate without the hassle. If you're dollar cost averaging and reinvesting dividends, you are constantly buying the same share or ETF at different cost bases. For example, investing monthly into 3 ETFs and reinvesting quarterly dividends would create 48 separate parcels in just 1 year. Now imagine building that portfolio over decades. You'd be dealing with thousands of individual parcels. Everyone talk about the benefits of these strategies, but no one mentioned the administrative nightmare they can create. It's fine if you never plan to sell, but life happens. When you eventually do, years later, you will need a full cost-based history, match each sale to the right parcel, and track what's left to calculate your future capital gains accurately. Navexa and Sharesight handle all of this for you automatically and in a clear, organized way. Sharesight even lets you generate an all trades report that you can download as a Google Sheet, PDF, or Excel file. Reason number 4, build a smarter capital gains strategy. If you have never used a portfolio tracker like Sharesight or Navexa, you might not realize that you can actually influence how much capital gains tax you pay even after the fact. A lot of people just assume you have to sell your earliest parcel, which is what's called first in, first out. But the ATO gives you flexibility. You can choose whatever parcel available for each sale. Both Navexa and Sharesight allow you to choose first in, first out, last in, first out, maximize gain, maximize loss, or minimize CGT. You can test different sales strategies to see how they impact your tax bill. The best thing is you don't have to stick to the same method every year or for every holding. If you have a high income year, you would generally want to minimize the capital gains tax you pay for that year. So you would choose the minimize CGT option. If you're on a low marginal tax rate this year, it can make sense to maximize gains now, in which case you choose the maximize gain option. It's all about shifting the tax liability to the year that's more favorable to you. Reason number 5, avoid the number one mistake ETF investors make, which is not adjusting their ETF cost base after receiving their AMIT statement, also known as the ETF tax statement. If that step sounds unfamiliar, I have a dedicated video that explains the whole process. Now, if you are across it and doing it manually, you know how painful it can be. If you have the same ETF for years with multiple buy-ins and dividend reinvestments, making those adjustments manually can be a nightmare. With Navexa and Sharesight, all you need to do is entering the figures from your AMIT statement, and the system will update your cost base automatically. Navexa takes it a step further. You can upload your AMIT statement and it will extract the data and fill in the details for you. Just be sure to double check that everything matches. Reason number 6, make tax time quick and stress-free. With Navexa and Sharesight, tax time becomes a breeze. Once you have maintained the basics, confirming dividends, entering your AMIT details, and setting your preferred CGT strategy, there is hardly anything else to do. With just one click, you can generate a tax report that matches ATO codes perfectly. Your accountant will thank you for it, and there is a good chance they will charge you less as well. Reason number 7, stay on top of dividends and future cash flow. If you're living off dividends or distributions, or just planning to one day, being able to see a clear estimate of your income over the next 12 months is incredibly valuable. Both Navexa and Sharesight offer future income reports. They have a clear chart and table that separates confirmed payments from estimates based on historical data. Without a tool like this, you'd be stuck building a pretty sophisticated spreadsheet and constantly updating it yourself. The difficulty of that is going to increase exponentially if you have multiple holdings across different brokerage accounts and across different entities. If you're serious about investing and growing your wealth over decades, tools like Sharesight and Navexa aren't just nice to have, they are essential. If you'd like to give them a try, I have partnered with both to give you extra discounts. Use my links below to get 20% off your first year on any Navexa plan. And with Sharesight, you get 4 months free when you choose the annual premium plan. Navexa offers a 14-day free trial and a 6-month satisfaction guarantee on every plan. And Sharesight has a free plan to get you started right away. Feel free to try them both and see which one suits you best. In my upcoming videos, I will dive deeper into comparing the two, and I'll walk you through how to get started as a beginner. Thanks for watching. I'll see you in another one.